If you just look at the market, there are around 10% of bonds in the global credit market which yield more than 8% in euros. So there are still very good opportunities. We have been skeptical about the potential for interest rate cuts to be a strong driver of market performance in 2024, and we do remain quite skeptical. The ECB has started its cutting rate cycle, but the Federal Reserve seems quite far from it. When you look at US data, there has been some sign of softening, but 2024 growth is still trailing 2 to 2.5%, a level which is close to potential or even a bit higher. Leading indicators are showing a little bit of softening, but hard data remain quite robust. So the US economy is very far from a situation in which the Federal Reserve would need to step in basically to support macro. Additionally, inflation remains quite robust. Core inflation is just below 4%. We had some sign of softening very recently, but the first quarter of the year has been particularly strong. And very importantly, financial conditions are not very tight, meaning high interest rates in the US are not really biting credit and are not really creating a problem in terms of financial conditions. It is possible to see a few cuts. We do expect a couple of cuts over the next 12 months, but we don't think a very big cutting cycle is necessary for the US economy at this stage. In other regions, we are seeing some cuts. Europe, for example, we are still skeptical about the possibility of Europe to cut meaningfully in absence of a very strong cutting cycle by the Federal Reserve. So far, the market has been pricing exactly the same amount of cuts in Europe and US for the next 2 years. Shall the market change its mind and shall the market start pricing more cuts in Europe than in the US? Currency will start moving, and this basically will be an obstacle for the ECB to continue cutting. So the ECB has gone first, but we don't think there will be a massive divergence. European elections were a big surprise for the market because they were supposed to be a non-event, and they actually triggered a very deep political crisis in France. In general, we don't think the crisis has the potential to unravel Europe. The market has the potential to weaken a little bit and to reprice some sort of political risk, and to remember that in general Europe remains a fragmented place. And we do think this was a bit forgotten by the market in the past 2-3 years. In particular, this happened at one time in which European fiscal rules are slowly coming back after a very long break that started with COVID. So there is the potential for some form of clash on fiscal issues right after elections. So European risk premia are set basically to go wider and higher as a result of this electoral season, even if the tail risk is probably low, but there is potential for some more weakening. So we do think another way of looking at France and European election is basically a comeback of fiscal risk premia, and we think this is a theme that can continue to be very important for markets. In the US, we do think the same theme is going to be priced. We have a very important election coming over the next 6 months. We don't know who is going to win, but we know that whoever wins is probably going to be a big spender in a different way. The Democrat platform is more focused on spending hikes, and the Republican platform is more focused on tax cuts. Credit markets had one of the best starts ever in 2024, and we find levels a bit stretched at this point. The overall performance of credit has been around 3% for high yield for the first 6 months of 2024, vis-à-vis 4% losses on government bonds. Such a gap is very uncommon and never happened in the past 10 years. At the current juncture, spread levels in Europe and US are very tight across credit quality. high yield and investment grade spreads are at heights since 2021, so the same level we reached in 2021, with the difference that in 2021 we had zero interest rates and now we have very high interest rates. So the fundamental pressure on high yield and investment grade issuers is now higher because the cost of refinancing is substantially higher. Still, the market is associating very little risk premium to the whole segment. Since the beginning of the year, we have seen a few capital structures coming under pressure in Europe and the US because the refinancing cost is so high that some companies, not all companies, but some companies found better to approach bondholders for a renegotiation of liabilities rather than refinancing the cost of debt. In the next 2 years, 30% of the high yield market will need to refinance debt, and only 10% had to refinance over the past couple of years. That means that situations like the one that happened in the first quarter are going to be more common in the next 2 years. There are still good opportunities. If you just look at the market, there are around 10% of bonds in the global credit market which yield more than 8% in euros. So there are still very good opportunities. There is still value, but not in your average bond, and so the approach to credit needs to be very selective at this point.